Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We begin with Douglas Irwin of Dartmouth College. Against the Tide is his definitive history. I read it cover to cover. Many other people just buy it and put it on the bookshelf so they can pretend they read it. It is trenchant. It is deep. And one of the examples you see of that is the actual work of Doug Irwin. Go back to 1997 and you get a 26-page paper out of NBER, Higher Tariffs, Lower Revenues, analyzing the fiscal aspects of the Great Tariff Debate of 1888. Professor Irwin, thank you so much for joining us. Are we reliving McKinley in 1888?
You know, the president referred to the 1880s in his remarks yesterday, and I think he's succeeded in bringing us back there. First of all, the average tariff on total imports is going back to levels we haven't seen since the 1880s or 1890s. It's taking it from about 2%, 3% today, up to perhaps 30%, and that's historically unprecedented. He talks about the revenue effects as being important, protective effects. These were all things that were debated in the late 19th century. And so we're reliving that in a real way.
Off your remit, but I'm going to go there. McKinley lost 86 seats in the congressional election of 1890.
Oh boy.
Is Trump going to find the same fury at the ballot box?
Well, I think as you just reported, car prices are going to go up. All sorts of other items that we hadn't even thought about are going to go up as a result of these tariffs, from avocados to phones to shoes. And, we've seen in recent years that the electorate is very sensitive to higher prices and inflation. And so, once again, speaking historically, anytime there's been a major increase in the tariff, when there hasn't really been a societal consensus behind it, when there hasn't been a lot of public support for it, the income party gets punished at the midterms. And that happened after Smoot-Hawley. That happened after the McKinley tariff in 1890. And we could be in for a repeat of that.
Professor Irwin, I was just reading your article in Foreign Affairs magazine, The Incoherent Case for Tariffs. It's very similar to what we heard from Professor Furman from Harvard yesterday that Tom and I had a conversation with. What is the counter argument that the president is getting in the White House for tariffs?
Well, I think actually yesterday provided some clarity about what the purpose was. As Jason and Chad and I and others have pointed out, we don't know, are these primarily for revenue, primarily to reduce the trade deficit, primarily to reshore jobs in manufacturing, primarily to strike better deals through reciprocity. And the formula used to calculate these tariffs was based on the trade balance. So it seems like that's the major consideration that they're trying to aim for. But the problem is bilateral tariffs may not affect those bilateral trade balances, may not affect the overall trade balance. Of course, if we go into a recession, the trade balance will shrink, but that's not exactly the mechanism by which the administration wants to reduce the trade deficit.
So at the end of the day, Professor, how do you think these tariffs will be implemented? I mean, how does the mechanism work? How are we as consumers going to kind of see this, do you think?
Well, businesses, most of U.S. imports, or at least a large chunk, are intermediate goods, components, industrial supplies, and things like that. So it will be businesses that will first feel the pinch. But then, of course, that raises their costs of production, or they have to seek alternative sources of supply. And to the extent there are higher prices, they have to pass those on to some extent. Of course, it sort of trickles down in some sense and is whittled down as you get along further the production process. But it's mainly firms that have to adjust to these in the short run. And then consumers will see an uptick in some of the prices of the goods they buy later on.
The grievance here, and folks, we're with Douglas Irwin of Dartmouth College, Ed Yardeni coming up, Elizabeth Economy with us in the 9 o'clock hour, really focused on China. Professor Irwin, the reality is the grievance and retribution of Mr. Trump and the assembled workers, construction workers, laborers yesterday, wrapped around senators in a rose garden. The grievance is a stereotype. It's not maple sugar makers up in New Hampshire. It's textile workers in North Carolina who lost their jobs to Vietnam so fancy people in a bow tie could buy a blue shirt made 60 miles northwest of Hanoi. Did he help North Carolina yesterday? Discuss with us this core emotion of America that we were taken to the cleaners by globalization and we want our pride back. Discuss that emotion, Doug Irwin.
No, that's certainly a visceral reaction among many people that we've closed many factories, we've lost manufacturing jobs. But as I and many economists have pointed out, most of those job losses are due to automation, not due to offshoring. Even if we bring back some of the factories to produce these things because the cost of importing is much higher, the jobs probably won't follow. Even with textiles and apparel, a lot can be automated. And so, when we think about the steel industry, which has always been near and dear to the president's heart, in the 1980s, it took 10 worker hours to produce a ton of steel. Now it takes one. We're producing just as much steel, but we just need many fewer workers and the type of workers that we need to produce steel has changed from blue collar to white collar, from hard labor to engineers monitoring equipment. And so the whole nature of the economy has changed. So we're not in the 20th century anymore. We're in the 21st century. And to go back to the 19th century is going to be really a hard pull. And that's why the markets are reacting the way they are.
What do you recommend from fancy Hanover? You should see Hanover. It's gorgeous.
Love it.
Absolutely.
Winter Carnival up there.
It's just gorgeous. What do you say, Doug Irwin, to White River Junction leveled for 40 years?
That's exactly. We're right near here in Hanover, right near many communities that were devastated. But the devastation goes back decades ago, even before the globalization, before NAFTA, before the WTO, structural change in the U.S. economy. A lot of those jobs went from the north to the south. If you go to Manchester, New Hampshire, right along the Merrimack River, there's a mile-long brick building, enormous.
Yes.
Used to produce boots, shoes, and textiles. But it hasn't done that for a century. Those jobs were lost in the 1950s or before, once again in the pre-globalization era, and those jobs went south. And the same thing has happened with Indiana, Michigan, Ohio, the Rust Belt in the north. A lot of those were still manufacturing stuff. It's just in the south. It's a different region where labor costs are lower, unions not so pervasive. And so we think we've lost things as a nation, but certain regions have lost out. And that's a very difficult thing to rejuvenate with tariffs. Tariffs are not going to help White River Junction.
Professor, does the U.S. economy risk being isolated in the global economy here?
Yes, I mean, you can see this. There's so much uncertainty about what's happening and what's going to unfold. So it could be that this sparks reprisals. I know the EU is considering countermeasures and what have you. And so the U.S. gets isolated and other countries retaliate in kind. But it could also bring a flood of diplomats coming to Washington, D.C., trying to seek a deal to get rid of this tariffs on their particular country. Now, so many countries have been targeted. That's going to be a lot of bilateral discussions over the next few months, and a lot of uncertainty about what's going to happen. But the damage could be mitigated over time through that way. But we'll just have to see how it works out.
On your commute across the nation, we say good morning to all of you on Apple CarPlay, Android Auto. Douglas Irwin with us of Dartmouth College. Edward Yardeni coming up here from Yardeni Research and Elizabeth Economy in the 9 o'clock hour. After Ed Yardeni, we have the Secretary of Commerce with Jonathan Farrow looking forward. That'll be a heated conversation, to say the least. Ed Yardeni, I think I learned from the path from London School of Economics to Chicago. A guy named Hayek said we would clear markets. All of the press this morning, from Irwin, from Furman, all of the experts that we talked to, Posen at Peterson Institute, Chad Bone, this is a disaster. Professor Irwin, Hayek wants us to clear the market. From your economics and trade analysis, how do we clear this train wreck?
Well, unfortunately, what can go up very quickly and fast, namely tariffs, don't necessarily come down quickly or fast, namely tariffs. We've seen that with history. So cleaning up the mess caused by Smoot-Hawley in the 1930s and the Great Depression, that took decades. The tariffs went up fast, but they came down slowly because you have to negotiate, because vested interests have a stake in perpetuating them that weren't there before, that governments become addicted to the revenue. I mean, if we're using these tariffs to offset some of the tax cuts, it's going to be what that means is to get rid of the tariffs, we're going to need to increase taxes elsewhere. And that's always a politically difficult thing to do. So reversing these things, once these steps have been taken, is very, very difficult.
With us, two giants of the business, Douglas Irwin of Dartmouth College and from Yale University, and of course his work with C.J. Lawrence. Nancy Lazar on the other day, Ed Yardeni from Yardeni Research this morning. Ed, the reaction to Doug Irwin's failed trade policy is a Dow down 1,100 future points. Is this the beginning of a bear market in a lesser Mag 7?
Well, I think so. I mean, up to now, the bear market has been the Magnificent Seven. The S&P 493 was actually flat for the year until this hit the fan, and now I think we've got a broadening of the market to the downside, and clearly we're solidly into correction territory. And once you do that, and you've got a major policy failure, you run the risk of it turning into a bear market. This has been kind of a free fall in the S&P 500, not so much in the the equal weighted S&P 500. That's where it's turning now.
Right. Let's get in one more question. Yardeni's playing paddleball with Blanchflower this morning up at Dartmouth, so we got to squeeze in one more here with Doug Irwin. Doug, we need a rewrite of Against the Tide. What's the new prologue, the new epilogue look like for your classic textbook this morning?
Well, Against the Tide is more about the intellectual history of trade, and there, I think the wisdom of Adam Smith still resonates. He had so many insightful things to say. He said there's nothing could be more absurd than this whole idea of the balance of trade, and that's the whole idea behind these bilateral tariffs. Right. And this other book called Clashing Over Commerce, which is a history of U.S. trade policy. Clearly, this is a new chapter in the history of U.S. trade policy. This is a major development, a huge increase in tariffs we haven't seen in decades. And it's going to reshape the global trading environment.
Professor Irwin, thank you so much. We're patiently waiting after Doug Irwin is Ed Yardeni, and we welcome him from Yardeni Research. Ed, you have parchment from Yale University. Ernie Tedeschi and Monica Gimbel are up at the Yale Budget Lab, Martha Gimbel, I should say, are up at the Yale Budget Lab just absolutely killing it on their analysis of these tariffs. Their analysis is grim. It's a $3,000+ weight to every single household in America. What does that do to the revenue stream of the Dow Jones Industrial Average?
It's not good, that's for sure. May I say something on behalf of the stock market vigilantes? Would that be all right?
Perfect. Yes, please.
On behalf of the stock market vigilantes, I'd like to say, Mr. President, take down this tariff wall. This is just the most absurd policy that one could possibly imagine. And it's a disaster for the economy. It's a disaster for the stock market. And I think the pushback on the administration from the stock market vigilantes is already quite intense. This is turning out to be not Liberation Day +1. It's turning out to be D-Day on Wall Street.
I mean, Ed Yardeni, you were weaned in this. I mean, to go back to the huge academic debates of the 20th century and the development of our great economic programs out to Stanford and UCLA as well, this policy, Ed Yardeni, isn't a 20th century debate. How far back is the president going? Is he beyond Stanley Jevons? Is he beyond John Stuart Mill? Is this guy taking us back to a mercantilism of the 17th century?
Absolutely. Well, I mean, really back in time, and certainly well before McKinley, which seems to be his favorite role model, favorite president in terms of tariffs. The president may love tariffs, but nobody else does. Nobody in the stock market loves tariffs. They are killers of economic growth. They lead to inflation. I mean, the president seems to be asking for a recession. He said that this would cause pain. I don't think he appreciated how much pain it could possibly cause.
So, Ed, as you think about investment, opportunities, risks here, what do you do with a portfolio today? What is a strategy in a world where we have substantial tariffs and therefore maybe issues with economic growth, with inflation? How do you position a portfolio today?
Well, there's so much uncertainty out there, but my feeling right now, and it could change rapidly depending on what the president says next, is that it's too late to panic. I think if you've got a good portfolio, you stay with it. I think that the political pressure on the administration to become more reasonable about this whole thing quickly is going to be intense. I mean, the Republicans are going to lose their majority in the midterm elections if nothing changes on this mistaken course.
Ed, I mean, it seems like I don't know where to go here. I think a lot of investors are looking at their screen this morning saying, boy, I've got the stock market down 3-4%. I mean, I've got yields plunging. I've even gold is off 1.8%. I'm not sure where to hide here. Any thoughts there?
Well, I think the only place to hide is in your portfolio. Just stay with it. I think we'll get through this. I think that there will be a lot of pushback to change it. I think I'm not the only one calling on the president to take down this tariff wall. I think the pressure is going to be intense to declare victory by getting some movement on the other side of the negotiating table, but to get victory and claim victory rather rapidly.
Bloomberg surveillance worldwide across the nation and your morning commute. Good morning. Good morning on Sirius XM. 99.1 FM in Washington. Good morning. Huge interest down there. Thank you so much for that. 92.9 FM up in Boston. I'm going to be up in Boston this weekend.
Really?
I couldn't get tickets for opening day. I got.
That's a tough ticket.
I got to sit down next to the on deck circle because they're just killing it.
There's a couple of bars near Fenway.
Really?
I think I can recommend to you.
Thank you. Like Sevens on Charles Street or over on Beacon Hill. Yeah, maybe I'll be at Sevens Friday night. We'll see 92.9 FM. What I do know is we're with Ed Yardeni here on YouTube. Subscribe to Bloomberg Podcast, commercial free. In 9 minutes, maybe 11 minutes, Howard Lutnick, the Secretary of Commerce for President Trump at the White House. Ed Yardeni, your work, the work of a wonderful Ed Hyman, Nancy Lazar, all of C.J. Lawrence, is a melding of the markets. So I've got this economy, and let's say I get a growth shortfall. Do you just bring that right over to single-digit revenue growth for NVIDIA, Microsoft, and the other Mag 7?
I think that's the conclusion. They are kind of tight at the hips of the market. Clearly is driven by earnings, and earnings are driven by the economy. Just a couple of days ago, in reaction to the auto tariffs, which are just as absurd as all the other ones, I lowered my outlook for the economic outlook from 2.5% to 3% all the way down to 1.5%. It was a painful decision to make, but that was the conclusion I came to. And what I've got the economy doing now is growing by 1% in the first quarter, then in the second quarter 3%, because I think people are going to scramble here to buy cars before their prices go up. And then I think we're looking at a growth slowdown, maybe no growth in the second half of the year.
Can it clear though? I mean, everybody showed up at the coronation, the inauguration. I'm kidding, folks. That was a joke with disrespect to President Trump. I'm sorry. At the inauguration at Yardeni, Bezos was there with Mrs. Bezos and all the others. Was Tim Cook there? I can't remember. But these guys,
yes, I think so.
Can they, Dr. Yardeni, can these guys line up, sit the guy down and say, it's the magnitude that you're doing that's killing us. Raise tariffs, but just a teensweet amount. Why can't these corporate titans get that done?
Well, I think up to now, the assumption was that the administration collectively knew what they were doing. But clearly with the reaction of global stock markets, that's not the case. There is no vote of confidence anywhere, not even in gold, in what this administration is doing. I mean, as you said, there seems to be no place to hide. And the only place to hide is to go to the White House and tell the president and the administration that this policy is just wrong.
But it is the policy of the day. So again, what are you suggesting investors do here? We oftentimes talk about a flight to quality, whether that's quality companies, quality stocks, great balance sheets, buying back cash, buying back stock, lots of cash flow. What would you say to your clients today?
Well, there's some amazing buying opportunities if you're willing to look past all this. Whenever you get, we've really never seen pessimism like this other than at the very depth of a recession, the very depth of a bear market. Usually when sentiment is this negative, that from a contrary perspective is a buy signal. The problem is that when pessimism is this negative, you also get a Fed put, you get the Fed lowering rates. But there's no way that the Fed can bail out the administration here by lowering interest rates, because they know, we know, that this is all going to lead to higher inflation, at least for 3 to 6 months.
Ed Yardeni with us, and we continue with Dr. Yardeni. Of course, Yardeni Research is Yale. We thought we'd take a break here. For those of you on radio, you have to observe it on YouTube. You can pick it up. Ed Yardeni, what is the name? You didn't name the beast behind you on the brown upholstered chair. You didn't name that dog Maynard Keynes, right?
No. That's Max, and I am working on creating a currency, a cryptocurrency named after Max. So you may see him with sunglasses.
Max seems perfectly calm, Tom, doesn't he? He's not worried about
He's not worried about the tariffs here. Is well.
He's very relaxed about the whole thing.
He is smart.
Speaking of relaxed, a colleague of yours, Robert Schiller, the laureate, wrote a book once. I sat with him in the New Orleans airport. We're talking book ideas and that, and I take no credit for this. But 6 months later, there was Bob Schiller, Ed Yardeni, out with a book called The Good Society. The president carries a grievance, the retribution of a huge part of America. We've consistently seen that, including his wonderful interview with John Micklethwait, our editor-in-chief. Talk to the people that are not advantaged by a New Haven education. Talk to those that feel the president's grievance and retribution.
Well, I say this as a non-political observation. The president got a pretty damn good economy. For starters, the unemployment rate's 4.1%. The inflation rate is quite close to 2%. The real GDP is at an all-time record high. Consumption per household is an all-time record high. This is not to say that there aren't people who aren't doing well. But all in all, from a top-down analysis, things are pretty good. But you asked me really from a bottoms up for the people who have been suffering. I don't know that these policies are going to make things any better for them. And the immediate impact is to do exactly the opposite of what most Americans voted for when they voted for those who voted for Donald Trump, wanted to see prices coming down. Instead, we're going to see auto prices go up $5,000 to $10,000. We're going to see auto insurance go up even more. Maintaining and repairing cars is going to go up. It's the immediate impact is not going to be a happy one for anybody in America.
So, Ed, I mean, there's obviously from the Trump administration, it's all about, I guess they would say, free trade has not been good for the U.S. We are getting ripped off. Is there evidence to suggest that free trade is not working for the United States? It seems like just a few months ago, we were talking about U.S. economic exceptionalism, how we were doing better than the rest of the world. I don't know what the problem is.
Well, everybody goes shopping, and they shop in Walmart, and they shop in Costco and other places. And a lot of the goods that we buy voluntarily without anybody forcing us come from overseas. I mean, do we really think it's realistic that Nike can make sneakers here at the without the price going up dramatically?
Well, this is I don't mean to interrupt, Dr. Yardeni, but we got economic data in 1 minute. We'll give that to you. Continuing claims out, some other stuff here. Paul Sweeney at 10 a.m. with the ISM Services Index. But Dr. Yardeni, Alexander Skaggs over at Wigglesworth brought this to us this morning over at FT Alpha. She said, look, we don't grow bananas. I mean, that's how simplistic this train wreck is.
Yes, we have. Yes, we have no bananas.
Yeah, well, that's what she said. I mean, Alexandra nailed it. I mean, Paul, you can't buy a Vespa in America. Exactly. You're not. If you bring a Vespa over to America, how about your BMW, Paul? Made in Alabama?
How about just last week I bought a Honda. I bought a Honda CR-V hybrid, vehicle. I don't know where it was built. I think it was probably built somewhere in the United States. But I mean, am I going to pay 20 or 25% more for that? I don't know.
Ed, this is really important. Let's frame this out. Sweeney's got a 6-car garage around the manse on the New Jersey beach. Professor Yardeni, America, in particularly doing better than good America, they like their foreign things. Politically, how does
Yeah.
that buttress into your work?
Well, look, I've always been of the opinion that at the end of the day, what's key to understanding what the standard of living is in America is consumption per household. At the end, maybe that's too materialistic, but that's an easy way to measure it. Another way to measure it is real wages. Real wages are all-time record high. I know there's been a lot of controversy about that, but that's what the data shows. Inflation-adjusted wages all-time record high. Employment is at an all-time record high, and consumption per household is an all-time record high. You can't explain any of that just by saying the rich are
Right.
getting richer. There's just not enough rich to account for all those developments.
Ed, one more question here as we tee up for John Farrow with the Secretary of Commerce. Professor, I call him Professor Yardeni. He's running a research note. Folks, subscribe to the Yardeni note. It's really good. He's got someone work with him who's better than good, makes it happen. I look at Yardeni at where we are, and the answer is the panic is go to cash. You are the great optimist. I'm sorry, Brian Belsky. Yardeni's the great optimist. Ed Yardeni, this morning, are you saying go to cash?
No. I think, again, I could be wrong about this. I think it's too late to panic. I think the Republicans are going to panic. I think they're going to realize that this policy is a disaster. I think the pushback from senators and representatives is going to be awesome. I mean, look at all these people that are retiring, people my age. I still have to work for a living because I got 5 kids and 4 dogs.
Oh, I would not know about that.
But my friends are all retiring, and they were really happy because they went on their cruises and watched their stock portfolios going up. Now they are mad as hell, and they're not going to take it anymore. They're going to be flooding Congress with complaints about how
Right.
instead of creating wealth, the president is just destroying wealth.
Ed, including pizza, is Yale University popping 100,000 a year? Are you guys popping 100K up at New Haven now on tuition? All in?
Well, I'm not a professor. I'm not there anymore. I'm here at my home office in Long Island, so I have not a clue what it costs. And my kids are beyond college, thank God. I pity anybody that's not the case.
Thank you. Max the dog, loved having you on the show. Ed Yardeni, thank you so much.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
No introduction necessary. Bob Michael joins us now, CIO with JP Morgan Asset Management. Thank you for joining Bloomberg today. Really appreciate it. I can't imagine. I've been up since 12:35 p.m. I know Michael Ferroli has and Casman. Right now, dovetail the Casman-Ferroli analysis of price up, yield down to a 403 handle on the 10-year yield. Does it aggressively change Jerome Powell's life? Does it change Wall Street and the fixed income market? Sum the JP Morgan analysis that's occurred since 5 p.m. yesterday.
Yeah, great question, Tom. And I've spent the last 12 hours combing through our research, and it all points to the same thing. Which is, given as how tariffs stand as they were announced, that's going to push the U.S. economy into recession. Right. They're dramatic. It's a tax on businesses and households. It's going to cause them to retrench. It's worse than most expectations. I think the caveat is, we don't know what the policy response will look like. We still have until April 9th for the majority of the tariffs to be enacted, so there could be a lot of negotiation. You have the Fed sitting with a lot of dry powder at 4 3/8%. They could bring rates down quite a bit, and you don't know what's going to happen overseas. You could see fiscal stimulus.
Tell me what you read in the bond market. You've got your team of people. He has 12 people who report to him. The team, what you see across full faith and credit, high yield spread in all. What have you observed since 5 p.m. yesterday?
I see confusion. I see the market trying to digest. Inflation could go above 4%. The Fed's hands are tied, and recession could mean unemployment cruises through 4.5% to 5%,
Is JP Morgan publishing a 5% what if on unemployment?
No.
I got to make some news here. Lisa's failed me today.
Okay, I've got news for you.
Please.
The Fed's hands aren't tied, and you'll love this. Where is Samuelson Econ 101 textbook?
You mean the 1948 textbook? The difference is, folks, I read it in English. Michael read it in Greek. Tell us about Samuelson 1948.
There is a difference in where the inflation is coming from. Demand pull is something the Fed responds to by hiking rates. That's what we saw after COVID. Cost push is what the Fed responds to by cutting rates because of the impact it has to businesses who see profitability erode and to households who see their purchasing power erode.
Paul, did you see how Bob Michael's lapels widened down his suit?
We talk about the 1940s, exactly. Hey, so Bob, I mean, you're sitting there at JP Morgan Asset Management. What are you telling your men and women who are putting money to work today? What are you telling them to do today? Do you dive into the sell-off here? Do you just say we need to recalibrate here because there's a new world order, maybe a recession in the offing? I
tell them bonds look great. Okay. This isn't a market with the Fed down around 0 and 1%, the ECB at -0.5%, -0.75%. This is a Fed at 4 3/8 with a lot of firepower to bring rates down. If there is no grand bargain and these tariffs hit in full force and there's some retaliation, the Fed could bring rates down 200 basis points, 2.25%, 2.5%. The entire Treasury curve goes down to the low twos. So get in, we'll put you in the right bonds.
Do you put...
We're selling them. JP Morgan had a slow day yesterday.
JP Morgan Asset Management, I love them. Credit risk, do I take credit risk? I can't even imagine taking credit risk today because I think a lot of people are just looking at the futures here. People are just stepping back.
You can take some. I think clearly you want to be up in quality. There's a lot in the banking system and financial services where banks look structurally overcapitalized because of all the regulatory environments of the last few years. But generally, you're right. You just want to pull back a little bit, see where the dust settles. You want to see more pricing in of potential recession.
Unfair question. I don't want you to get in trouble with the general counsel working for Mr. Diamond today. He works like a 6-hour day. It's amazing. Bob Michael, it's as simple as this. We didn't know on a day in October 87 about portfolio insurance. We didn't know Myron Scholes was working a hedge fund with a 20-to-1, 30-to-1 leverage in 1998. So here we are now. We all agree that banks, including your brilliant bank, are solid and, thank you 2008. It's a fortress diamond in that. But there's other leverage issues out there like private equity, private credit. They're not on your remit, but we're all in this together. Do you worry about shocks or systemic risks out there from this Trump trauma?
See, Tom, there you go. We knew those things. We knew about portfolio insurance. We knew about everything that you talked about, but we ignored it. I think private capital is a big one that's out there. When we look at the private credit markets that have about $2 trillion, that's 2/3 the size of the entire U.S. banking system when you look at their commercial and industrial loan book.
Unregulated?
Let's call it lightly regulated. Is it ripe for a shakeout? Yes. Is it disaster brewing? Absolutely not. There are areas like that which we're looking at. You could see a shakeout, but there's nothing out there that tells you this could evolve into a significant crisis.
So what are you telling your clients today? I'm sure you're going to be on the phone. You're going to be doing Zooms all day with your clients. What's the message today?
The message is that next week is a long time away. The administration has left the door open for negotiation. Let's see what happens. But we're going to be left with some level of tariffs, and some level of tariffs is a tax on businesses and households that will slow things down. And inflation, that will pop up mid-3s, maybe up to 4%. The Fed has already told us they're going to look through that because that's cost push inflation. So expect that if things slow down too much, the Fed will bring forward rate cuts.
1 minute here. I got the first print on the 10-year real yield today. Folks, we were at 2.0%. a Sanka ago, and now we come in, we're at 1.72% on the first print in 7 basis points. Where is a 10-year real yield where you say we're back to what we used to know in terms of low yields? Is it a 150? Is it a 120 10-year real yield? What's the Bob Michael number there?
Yeah, I think a real yield on the 10-year should average about 2%. I will tell you, this quarter, I'm willing to accept a much lower real yield on 10-year treasuries to protect me to the downside against recession. So I'll go as low as a 1% real yield.
Wow.
Thank you so much for coming in.
Yep.
We have 2 chairs here. Lisa needs to go up and get a gluten-free breakfast. Bring Mr. Diamond with you next time. To interview Diamond and Michael together would be really cool.
We're going to do a remote when they open their headquarters on Park Avenue. I've already talked to Jamie Diamond. We're working on that. We're working on that. So.
You know, they got.
Come on over.
Have you picked out the color of your carpet yet in your office?
I walked through the building 2 days ago. It's fantastic. Can't wait to move in. End of August. Come on over and visit.
We're doing
Did you pick out the maroon carpet like Bill Murray in Lost in Translation?
Corporate will pick it out for me, and I'll be happy with it.
And you and I
will be happy with it.
You and I can't imagine the number of designers involved in that decision. Bob Michael, thank you so much for coming in. A huge day for JP Morgan.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, surveillance irrationality correspondent Tina Fordham. She is with Fordham Global Foresight in London. Tina, let me cut to the chase. How will the Prime Minister respond to this?
Well, the Prime Minister here in the UK will respond with relief. Britain got off lightly with 10% tariffs. Now, that is partly because the UK is an exporter of services more than goods. But like all politicians in this environment, Keir Starmer will be glad to take credit for having a successful policy with President Trump.
Holger Schmieding just mentioned a 2-month interlude to straighten out, as he said, this irrationality. Tina Fordham, can our listeners and viewers survive 2 months until the adults show up?
I think that sounds like an eternity. And I suspect that we're going to see a fairly nuanced and sophisticated response from the European Union. I think the tension is best framed as between placating Trump and retaliation. And if you look at public opinion data in the European Union, there's strong public support for retaliating against the US. But there will also be, of course, a desire to play nice, I think, to start with. And try to see about taking these down a bit, because 20% is harsh.
Yep. So, Tina, I'm just looking at your notes here. Liberation Day will go down in history, but not for the reasons President Trump expects. What do you mean by that?
Oh, I think you know what I mean.
Well, lay it out for us.
Yes. I mean, it was astonishing. Let me put it this way. I was watching in London with my 17-year-old and my 20-year-old. And my 17-year-old said, Mom, isn't this how the Great Depression started in the United States? Because he's studying that period right now. It will go down in history as a voluntary act of self-harm when the biggest and most powerful nation in the world abdicated from its position in the global system and moved out of that into a deals-based, seemingly ad hoc set of relationships with highly unpredictable policy that's going to end up costing U.S. consumers, among other things.
It's interesting, Tina. I was just speaking to John Tucker, who talked with our radio affiliates all across the country here in the United States, and he was saying, in the last couple of days, he's heard nothing but positive support for President Trump and his tariff policies here. So I mean, there's a lot of folks that feel like the Americans are getting the short end of the stick from global trade. What do you say to those folks?
And it's very moving, of course, to see the UAW guys in the audience coming on stage. Deindustrialization hit America very hard, and that speaks to what happened with globalization, the stagnation of wages and everything else. So, let's be clear that there is no question that there were a lot of people left behind by globalization, and they are Trump supporters. But looking at the data, Trump's approval ratings have declined slightly from around 47% to about 43%. The ratings have dropped more on economic competence. And so here's where I would introduce a little nuance. The tariffs are not popular. It does seem that Americans understand that this is likely to cost them money, and we've seen that hit in consumer sentiment. Righting the wrongs of globalization is popular. And so the question is whether these policies will accomplish that, isn't it?
If there's a ballot box repair, folks, in 1890 with McKinley, the Republicans were destroyed in the election. They lost 86 seats in 1890. I'm not predicting that or anything like that. But Tina Fordham, do you have an assumption here that on your reading of history, that trade and tariff excesses are solved at the ballot box?
It doesn't look good for that. And I mean, we know that President Trump and members of his cabinet and advisors are drawn to this late 19th century period when perceived U.S. power was at its peak. But the world has moved on since then, and it's not clear whether you can turn back the clock and whether manufacturing jobs are really the answer. And this is where policy types like me are very unimpressed with these efforts. They do play well to people because there's a very strong sense, and I call it stop the world, I want to get off. That things are moving too fast, that the world has become unrecognizable. And this is where politicians that offer a prescription are, it's resonating with people. And sorry, the point about what happens at the midterms, Wisconsin judge went one way and Florida another way. We're only 3 months in. Historically, the party in power, though, does get hammered at midterms. And that's even apart from having taken such dramatic steps to alter the global system.
Tina, thank you so much. Can't wait to see the writing, as Paul mentioned, the research notes from Fordham Global Foresight. I can't wait to see those in the coming days.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Her book, The Third Revolution, was my book of the summer a number of years ago. Another book, A World According to China. She's someone that's done great duty for America with Raimondo at Commerce here a few years ago. We're thrilled that she could join us now from Stanford University. Dr. Economy, Beijing takes us in. How will they respond?
Yeah, I mean, I think they've already started to respond. I think, they clearly stated that they want the Trump administration to rescind the tariffs. But beyond that, they put a stop measure on all Chinese investment into the United States. Not that that's such a big deal. It's only a couple $2 billion last year, I think. So it's not that meaningful. But I think we can expect, that they have developed their retaliatory toolkit to a very fine degree. So we will see some reciprocal tariffs. We will see some punishment of U.S. companies, investigations, antitrust investigations, things that they'll just create to cause problems for U.S. companies. We may even see some boycotts of companies that sell their products, consumer products into China. Probably, again, some new restrictions on critical minerals, licensing requirements, potentially, they have a lot of different things that they can do, and we can expect to see the full range of them.
Some people are writing this morning out of Yale University that these are basically a level of tariffs and harm back to 1909. Dr. Economy, let us go back not as far, 1911. China was a Qing dynasty. There was a revolution. There was a failure of their democracy to stagger through 10, 20 years to get out to Mao. What is the political stability right now of the Xi regime across China, given this unilateral shock from Donald Trump?
The Chinese have a pretty high capacity to endure pain. And the truth is that what the United States is doing will simply enable Xi Jinping to rally the troops behind him. And this is not even something that's just targeted at China. It's a Trump, worldwide effort. And that means that Xi Jinping can paint the United States as sort of an unstable partner, an irrational actor. And so it will hurt China economically, no doubt, particularly at the low end, manufacturing, some of the e-commerce exporters like Shein, they will clearly take a huge hit. This is not coming at a good time for them. Their economy has been struggling, haven't, rebounded yet to pre-pandemic levels of consumer spending. They're doing their best to try to, improve that, but it's been difficult and it will continue to be difficult. So it's tough. But they will soldier through this. And Xi Jinping is already out there. He was just in Japan and South Korea talking about making more progress on a free trade agreement, talking about working together with them on supply chains. He's heading off to Vietnam and Malaysia soon. So he's going to take advantage of what the United States is doing globally to improve China's position, its trade position, its economic position globally. He's going to try to present China as the stable, pro-globalization power in contrast to the United States.
Elizabeth, you mentioned the health and of the Chinese economy. Do they have the ability to engage in a trade war successfully with the United States? Do they have that economic capability?
I mean, they have the economic capability to the extent that they have spent some time over the past 4 years beginning to diversify their economy away from the United States, both in terms of ensuring that they have, their own supply chains domestically. That's Xi Jinping's dual circulation. He wants China to be able to innovate, manufacture, and consume largely within itself. They've also shifted production to other countries to try to get around previous Trump tariffs. So they've been making more in Vietnam and Mexico and other places. Of course, given the Trump tariffs now, that'll be more problematic for them. But again, their exports to the United States, I think, they only export 14% now to the United States. And they've reduced it significantly over the past several years. It will be difficult, but they will find their way through.
Liz, just because of time, I got 8 ways to go here. Is this a 4-hour conversation with Dr. Economy?
Absolutely.
I think so. Liz Economy, I guess I got to go here, and it's never off your remit because you're so definitive on Pacific Rim. But the unspoken is the worry about Taiwan. The president goes after Taiwan's semiconductor. We've got 2 military bases on the north tip of Luzon Island in the Philippines, and on and on. Should our listeners worldwide have a concern about opportunistic Beijing taking out Formosa?
No doubt, there should be concern. I mean, Xi Jinping has said that unification with Taiwan is one of his 14 must-do items for the great rejuvenation of the Chinese nation. We've seen a dramatic ratcheting up of Chinese military exercises around Taiwan. They've clearly been practicing to do a blockade. So I think we definitely need to be concerned. And President Trump has been very non-committal about Taiwan. I think his administration is split. We have, in terms of whether or not the United States would come to the aid of Taiwan, were China to take military action. I think National Security Advisor Hegseth and Secretary of State Rubio have both been pretty firm in their commitment and overall pretty internationalist in terms of our Asian allies. Whereas I think, Elon Musk has likened Taiwan to China as Hawaii to the United States. And President Trump's moves to get TSMC to do these major investments on top of CHIPS and Science Act, his call for Taiwan to spend 10% of its GDP on defense, which is, crazy. But nonetheless, they can be seen as, in 2 different ways. They could be seen as President Trump saying, you do these things, And that's enough to satisfy us that you're taking your security seriously and we will be there for you. Or they could be seen as President Trump actively trying to reduce U.S. dependence on Taiwan semiconductors and basically signaling that we're not going to come to their aid.
Paul,
so everything's up in the air.
Paul, get one more question in here. I mean, she's a trooper for being with us from Stanford this morning. Get one more question into Dr. Economy.
Elizabeth, to the extent that the U.S. is backing away from the global stage, are Asian countries, I don't know, Vietnam, Malaysia, just the South Korea, maybe even Japan, have any scenario where they would engage with, maybe even embrace China?
I mean, they're already embracing China to some extent. We saw that with the meeting with Japan, South Korea, and China. I think it was just last week, where they talked about moving forward on a regional free trade agreement, working on supply chains together. I'm just waiting for Japan and Australia to signal that they're going to welcome China's move into the comprehensive and progressive CPTPP, right? A trade agreement that we pulled out of in Trump 1.
You got a time and date on that, Dr. Economy? I mean, I don't,
and I'm praying against, I'm praying and praying that doesn't come to pass.
Right.
But I am quite concerned because these are issues that just 6 months ago, supply chains, and trade and engagement on technologies, all of these things were things that we were doing with our allies like Japan and South Korea. And now it's China stepping into the breach.
Liz, thank you so much for joining us on Bloomberg Surveillance today. Dr. Economy, the classic is a river run black, so many tour de force along the way. We anticipate her next book, of course, from Stanford University.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.